Bread with Tom Hartman. I'm your host, Tom Hartman, on this beautiful October 30th, 2025. Halloween is right around the corner, but that's not the holiday we care about. Today was Fed Presser Day. That's right, the day where Jerome Powell, high priest and spreader of good cheer, comes to the pulpit to speak to all the little boys and girls gathered from around the world to hear the news from the Lord of Liquidity. Find out what's going to happen in markets in months and years to come. Why? Because from his lips comes forth prophecy, and that prophecy can be mucho dinero in your pocket. Well, let's cut to the chase and see what people are saying today. So the FOMC cuts rates by 25 basis points, so to 4.5 to 4.75, and ends QT December 1st with 2 dissents. So we have here the standard cut. So Nick Timiraos, End of the King, says here that the October FOMC decision, the Fed cut rates by 25 basis points. There were 2 dissents. So Schmidt favored no cut, and Marin wanted 50 basis point cut. Ooh, 2 very different sides. Button heads, Game of Thrones things going on here. The Fed will end QT on December 1st, and MBS redemptions will be invested into T-bills after that. All right, so the Fed will end quantitative tightening on December 1st. Mortgage-backed security redemptions will be invested into T-bills after that. The statement changes mostly mark the market, the outlook, notwithstanding available data instead of recent data. So from that Fed speak, where they change certain words, certain orders, the weather and the future. Moving on, we have summary from Kobe Letter, who states that the labor market, that the salient points from those remarks were that the labor market is weakening and inflation remains somewhat elevated. Available data suggests outlook has not changed. Job gains have slowed significantly this year. Higher tariffs are resulting in higher overall inflation, and Fed members had strong different views on the upcoming December Fed meeting. Another Fed rate cut in December is far from assured. That's my favorite line from this presser. And there's clearly growing divide in the Fed, as you can imagine, as we're moving towards all being replaced by a Trump toady. Let's go with that. Here we go. Next up, we have Jim Bianco, who talks about when Powell, actually, let's listen to what Powell said at the actual presser, this whole line about that the cuts in December are not guaranteed.
Claire. Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. So you can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And, some will be more averse to inflation overruns and some will be more averse to underruns of employment. And so you put that together. And as you can see from the SEP and from the public discussion that goes on between the meetings when more participants go out and talk, they're very disparate views. And they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, that we haven't made a decision about December. I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here. Is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just...
There's that line. In fact, Far from it. That the rate cut in December is not to be taken for granted. The market's already pricing, the silver market's already pricing in that the Fed would cut. I mean, it's not crazy. They basically said that they would. They're essentially on the rate cutting cycle. And when Powell went out to speak, there was all this talk about, hey, one rate cut of 25 basis points in September, how's that going to be enough in order to help people? And he was saying, hey, well, the Fed operates with forward guidance. And that because the markets are anticipating these cuts in the future, they've already priced that in. And there was like a 92% probability or something like that that the Fed would cut in December. And now those odds have dropped to like something in the 60s. So he's sort of walking that back, sort of suggesting like, hey, whoa, it's not a foregone conclusion. Excuse me, sir. You were saying it was basically a foregone conclusion and you were counting on that. Well, maybe markets ripped too high, right? We saw all-time high after all-time high after all-time high for the stock market. Maybe that's what it is. And they're trying to rein in irrational exuberance or animal spirits in order to bring the market down. Or maybe they don't like the idea that the Trump administration is trying to strong arm them into cutting interest rates. I mean, we saw that the one person on the one voting member, Stephen Marin, who was handpicked from or used to work for or currently still works for the Trump administration but is on leave or something like that. He's the one who said 50 basis points because we know Trump wants to get to 1% as soon as possible. I guess this is his leverage. He's not guaranteeing it, and markets sort of pulled back. Bad news. Not equity markets. Those still rose to all-time highs, but there was some volatility during the day, and then obviously some volatility still inside of the bond market and futures market. Jim Bianco talks about this, and he says, when Powell said that a December cut was not a foregone conclusion, he looked down and read it off a script. It was a deliberate message and not a one-off, not a off the... This updated chart says the market noted this. December cut probability was 95% yesterday, now 62. Moving on here to our last item. This comes from Lynn Alden, who did an interview on Blockworks talking about QT. I thought it might be fitting to hear about this. This I believe came out before the Fed presser.
Basically, we're getting increasing signs of liquidity strain. It used to happen a couple times at the end of a quarter for window dressing. Now it's happening mid-quarter, which is why this time's different than prior months. The Fed is likely going to end quantitative tightening soon. It could be at this upcoming meeting. We don't know yet. They have some flexibility for when they do it, but it's likely going to be somewhat soon. And then in the coming months, they're likely going to go back to mild balance sheet increases. Now, probably on Twitter X, you'll see people saying, oh, we're going to hyperinflate, or oh,
QE is here, QE infinity.
Yeah, banks are failing, or this is happening. I'm in the camp that it'll be a relatively slow balance sheet increase. Now, maybe down the line, we have another crisis and it ramps up again, but this particular phase, we're exiting a period of slow balance sheet reduction, perhaps entering a period of flatness for a little while, and then most likely entering a period of gradual growth. The New York Fed has been putting out papers for years forecasting this. They forecasted that by 2025, 2026, the balance sheet reduction will end, and then they'll go to a period of balance sheet increases in line with GDP, so you get a pretty flat share of GDP balance sheet increase. And then also specifically, they expected that they would continue to reduce mortgage-backed securities by letting them mature off the balance sheet, but they would resume treasury purchases. And then over time, a larger share of their balance sheet would tilt toward treasuries, even as the overall pie is growing. And that is my base case. I think that they did forecast that pretty well. They roughly know where their boundaries are. They have clues when they start to get closer. Like you start to see usage of the repo facility, you start to see spikes in collateralized lending rates. And that's when they know that their estimates are becoming reality. And I think we're going to enter a period of persistent but mild balance sheet growth, and that it is pro-liquidity, but it's just one factor among many in markets to consider.
Well, that's it for Daily Bread for today. We're going to leave that there until tomorrow, where we'll see what the ramifications are of this Fed rate cut. Thank you very much. Thanks for watching.